The US dollar is on pace to post one of its worst performance that we've seen in decades. This is Megan Horneman. I'm the Chief Investment Officer of Verdence Capital Advisors, and we're here today to give you an overview of our third quarter white paper, where we discuss why the US dollar has been performing so poorly this year, and then give some education behind what moves a currency. What does a weak dollar mean for businesses, for consumers? And then what's our view that we see on the dollar in both the near term and the long term? We're going to focus on the 5 primary factors that influence the value of a currency. First of all, it's interest rate differentials. If an economy has higher interest rates, investors want to invest there because there are a better return potential. The U.S. has seen a lot of capital flows because in the years after the pandemic, as you can see in this chart, the U.S. was able to raise interest rates much more aggressively than some of its major trading partners. Well, this year we're in for a situation where the Federal Reserve is cutting interest rates, so that's taken some steam out of the dollar. When you look at inflation, inflation can erode that purchasing power of a currency. So if you have high inflation, that's a concern for the currency. If you look at economic growth, if there's better economic growth in an economy, it's just like a company. If you think that the economic growth is going to be better, or you think earnings growth is going to be better, you're going to buy that company. You're going to buy a situation where you think that there's better potential for growth. The fourth factor is deficits. If a country's spending more than they're bringing in, this is a concern for the long run. Now, many economies have been able to really get away with this in the years after the pandemic because they've all really been in the same situation. The fifth thing is geopolitical or internal political risks. Would you invest in a country that has a lot of geopolitical turmoil? No. So that value of that currency gets dragged down. Same thing goes domestically. If you're concerned about no confidence votes for example, in Europe, or government shutdowns in the US, this takes some steam out of that currency. It's a confidence thing, and that can impact a currency. All of these factors have combined this year for us to see this weakness in the dollar. We want to discuss the importance of the US dollar as well as dollar cycles. We've had several dollar cycles since the late 1960s. You can see in this chart, though, they don't always coincide with economic cycles. In fact, we've really only had 3 true bear markets in the dollar. We've had 3 pretty big bull markets. The current bull market started in 2008, and we have seen near bear markets during that time. It has not been an easy ride, but we have enjoyed long dollar cycles. That's because the dollar is the world's reserve currency. The dollar makes up 60% of the global currency reserves. It makes up about 50% of the global trade transactions. And if you look at the $30 trillion US Treasury market, about a quarter of that is owned by either international investors or international central banks. It is a key component to how the globe operates. So the dollar has been able to run deficits. The dollar has been able to have some inflation, but the dollar still is very important to the global trading system and to really the global capital markets. A currency, especially the dollar, can impact not only investors, but also businesses as well as the economy. From an investment standpoint, if you're a U.S. investor buying something in U.S. dollars, it doesn't really mean much to you if there's a lot of fluctuation in the dollar. But if you're a U.S. investor and you're buying, for example, a stock in Europe that's in the euro, if that stock rises 10%, but the currency declines 10%, you've detracted from your total return on that investment. So currencies do carry a risk when it comes to investing. It is important to understand that. But it also does add another layer of diversification. Take, for example, some of those dollar bear markets. These situations, there are times that you should have some level of diversification across the globe. From a business perspective, if you're a multinational company that sells a lot of products outside the US, if we have a weak dollar, that actually makes you more competitive. So it can be a good thing for you. From an economic standpoint, though, it can impact inflation. Weaker currencies or a weak US dollar does impact inflation in a negative way. Take, for example, this chart. Most of the commodities are traded in US dollars. So what we saw from about 2001 to 2008 was a very weak US dollar. Well, that means that those commodities that are priced in dollars, international buyers can buy a lot more of them. That can drive the price of commodities higher, and that inadvertently drives inflation here at home higher. You can see here that we saw in the dollar decline substantially, and the price of crude oil rose to a record high of over $140 a barrel. So it can have impacts on inflation if you have a weak currency. Now that we've educated investors on what drives a currency, what it means for businesses as well as investors and an economy, we want to just kind of give our short-term and our long-term view on the dollar at this time. In the short term, the dollar is really the best house in a bad neighborhood. Growth is slowing, we realize that, but economic growth prospects are still better in the U.S. than the other developed markets. The interest rate differentials are expected to remain wide. These are things that will, while we likely have peaked in this cycle, we don't see a substantial downside from here. And I'll highlight again, the dollar still is the world's reserve currency. For the long run, though, the deficit situation is a problem here in the U.S. We're looking at debt to GDP ratios more than double the historical average over the next decade. That's a problem for the currency. The best way to hedge against this is to be diversified. As we mentioned, the dollar moves in cycles just like the economy. So if you have diversification across several different currencies, several different economies, this can help smooth out those cycles and those returns that might be impacted from a weak dollar. Thank you so much. And we invite you to take a look at our podcast that we have at Verdence. Markets with Megan goes over the regular economic data and what that means for the markets and the economy. From the ground up, our CEO, Leo Kelly, does a great job interviewing business owners and then discussing their success and how they've exited their businesses. The alternate view from our head of alternative investments breaks down those really complex alternative investments that are important as part of a well-diversified portfolio. Again, if you have any questions, please reach out to your financial advisor. Thank you.